Once in a while, you might find someone who is selling their business. How do you decide the maximum price to pay? My name is Dr. Johnny Yamunda, and today let's talk about how to determine the maximum price to pay for a business using the discounted cash flow method. The discounted cash flow method is premised on that the price you pay for an investment is a factor of cash flow the business generates. So basically, you are discounting the cash the business is generating as shown in this timeline. So in this timeline, we are seeing that it has 5 periods. You are getting cash flow in period 1, 2, 3, 4, and 5. And that cash flow, you're discounting it to the present value. So then when you add all the present value, that is the maximum price. And you need to have a required rate of return, which you use to discount these cash flows. Okay, so now let's look at an example. So Mufumi Holdings approached by Shasha to buy its supermarkets. Mufumi's required return is 20% and payback period is 3 years. Shasha reports next profit is 300,000, growing at 15% per year. Tax is 28% and straight line depreciation 35,000 per year. Calculate the maximum Mufumi should pay for Shasha using the discounted cash flow method. So the first thing we need to do is to calculate the cash flow. So the next cash flow is 300,000. We'll put it in the box. And we know that that cash flow is growing by 15%. So 300,000 grows by 15% gives you 345 grows by 15%. 345,000 grows by 15% gives you 396,750. Then we are told here that the tax is 28%. So 28% of 300,000 is that, 28% of that is that, 200% of that is 111,090. So the net profit is simply 300 minus 84 gives you that, 345 minus 96,600 gives you that, that minus that gives you that. Then we add back depreciation. Let's pause there. Why do we add back depreciation? Remember, depreciation is not a cash flow item. So since it's not a cash flow item, we are using what we call the discounted cash flow method. So we need to add back the depreciation. So 216 plus 35 gives you that, that plus that gives you that, that plus that gives you that. Then we need to find the discount factors. You can go to the back of your module and look at the discount factors in table number 1. You will find that the first period, 15% in the first period, first value is 0.8696. Second year, 0.7561. Third period, 0.65. So now we multiply this net cash flow times the discount factor. So 251 times that gives you 280. Then that times that gives you that. That times that gives you that. If you add everything, 643, 391.14. That is the maximum price you ought to pay. You know, it's never enough to talk about these things without you doing your own example. So do this Tongogara example and then you'll go to the next slide to look at the answer. So if you got your answer as 1293561.51, I'm so proud of you, my friend. You are too good. But what you would have done is you would have gone and looked at 450 and you put it there. Then you grow it by 10%. It gives you 495, gives you that, gives you that. Takes on that 450 times 28% gives you that. And then that this minus that gives you that net profit after tax. Then you add back your depreciation, you get that. Then you are looking at your present value interest factor of an amount in the table. First period 12% and first period is that. Second period, third period. Then if you add everything, it will have given you this answer. What did we discuss today? We said the maximum you should pay for an investment is the present value of its future cash flows. That bottom line, that's what we are trying to discuss, to say when you are valuing an investment using the discounted cash flow, you need to know the cash flows and your required rate of return. Thank you and goodbye.